Valens Research, Uniform Financial Analytics.
Walmart is very interesting because literally, if you were to look at Walmart, you would think that you had a company that had directionally different growth than it really does. So if I look over the last 2 years, you would think Walmart was actually growing its business pretty massively last year, right? In 2019, the as reported growth for Walmart was 7%. For a company as big as Walmart is, a company with a $300 billion plus market cap, it has a massive amount of investments. Let's just actually see how big Walmart's invested capital base is. So what this tool is right here, just so you know, is the impact of adjustments tool. Lets us understand how we get from the as reported metrics for a company to the uniform accounting metrics. Right, as reported assets for Walmart is around 220 billion. The uniform accounting adjusted true asset base for Walmart is about 170 billion, right? 170 billion growing at 7% is basically a growth of around $12 billion in new assets deployed by Walmart. That is a massive amount of growth. And so you would think Walmart is massively growing the business and returns are steadily declining. In reality, Walmart isn't massively growing the business. Walmart actually shrunk in 2018. It didn't grow. And in 2019, it only grew modestly. So it is not massively growing into a declining business. In fact, what they're doing is they understand that returns are falling. And as returns fall, they do need to be smarter about not growing, right? As returns really crossed over on a uniform accounting basis from 11 to 10 to 9, Walmart really shut off its growth for the first time in its lifetime. And only as they're trying to figure out how to turn around the business are they actually starting to theoretically think about growing again. And so the question might be, okay, now that I understand that Walmart isn't growing, what does that mean for valuations? And so what we can see here is we look at these white bars, the market is already pricing Walmart to basically not grow, but also see returns inflect massively higher. Basically, the market is saying, yeah, Walmart's issues in terms of competition and everything else are going to be fine. It's going to get back to 2010 levels going forward. Now, what we look at is we say Walmart has been smart to shut off their growth the last 5 years because returns have been declining as they've had competition from Amazon, as they've had competition from a number other of different avenues, and as they've seen less people want to go to a Walmart superstore. Well, quite frankly, that tells us that it is reasonable for Walmart to not want to grow because they're going to struggle to be able to boost ROAs. And the market's already pricing ROAs to be boosted. So when we look at Walmart, we quite frankly look at it and say, hey, the market's probably already pricing in the best case scenario for this company. The market's pricing Walmart to have a phenomenal turnaround. If Walmart does, well, the stock's fairly valued and the stock is trading where it should be. You could be sitting on dead money for the next 5 years as Walmart's ROA gets up to where it should be. But if the market's wrong, if Walmart actually doesn't generate higher returns, well, there could be significant downside for Walmart. Let's actually just look and see. If Walmart's ROA, let's say, just stayed at 9% levels going forward, what would Walmart be worth? Walmart, if returns stagnated, would be worth 35% lower than it is at the current stock price. It wouldn't be worth $116 a share. It'd be worth $75 a share, right? And these are the kind of insights that we can see when we do scenario analysis and understand what the market's pricing a company to be, but what the company could also be if it also saw returns decline or it saw returns decline or whatever we think our fundamental thesis of the company is actually played out.
Valens Research, the world's leading source for uniform financial analytics.